Hey, what's up, Nashville? We are back with the Free Speech podcast after taking some time off for the holidays. I will tell you, I took actually very little time off. I just kind of switched to a different project. I've got a ground up development going on, which is not my specialty. So I took those few weeks and really leaned into that project. So I didn't get any time off, but nevertheless, we did not film any new podcast episodes. So we're going to be covering stories from the last few weeks. We've got a lot of interesting things to discuss today. I'm going to give you a brief overview of the stories that we're going to cover today, and then we'll get into it, right? So I'm going to give you an Oracle update. A big deal was the recruitment of Oracle to Nashville. A lot of moving parts with that move. I'm going to give you an update. It's that important that we're occasionally going to review what the Oracle deal means to Nashville and kind of where they are in that process. So we'll start with Oracle. Next, Nordstrom's is going private. The Nordstrom family struck a deal to take back their family business, take it off the public markets, and I'm going to tell you that story. Next, we'll talk about Big Lots. Big Lots closes, and then shortly thereafter, they announced Big Lots finds a buyer. I'll tell you that story. Next, a head-scratching loss for Phillips Plaza. Many millions of dollars supposedly lost on this deal. I'm not buying it. I don't think all the details have really come out here. I'll tell you that story, and then we'll keep you updated as we learn more. Jimmy Buffett's Margaritaville sells in a record-breaking deal, and we just found out who the buyer was. I'm going to share that to you. Nashville is a top retail market in the country. I'll explain to you how we stack up on that list. Tennessee remains one of the top states in the country when it comes to attracting new residents coming from U-Haul, who tracks one-way U-Haul rentals. I'll let you know where we landed on that list. And lastly, Party City closes abruptly. I'll tell you the story of that retailer. As you know, if you've been listening to the show for any period of time, retail has seen a number of bankruptcies, closings, liquidations. They're really struggling. Big Lots and Party City both fell before the end of the year. So those are all stories that I think are worth learning about. So let's get into it. An Oracle update. Nashville to be the future world headquarters of Oracle Corp. I don't think the average layman understands what a big deal that actually is. So let me provide you with some more information so you can put this in perspective. This is the most epic economic development recruitment in the city's history, pledging 8,500 jobs by the end of 2031 on a $1.35 billion riverfront tech campus on the East Bank. Oracle will become Nashville's second largest publicly traded company by revenue, behind only HCA Healthcare. Revenue is one metric, right? Another metric is how much are those companies actually worth? What is the value of those companies? Oracle is worth $500 billion on the stock market, which is 6 times the market cap of HCA. So if we're measuring by revenue, HCA is bigger. I would certainly think that the more accurate metric is value. And when we're looking at the business's value, Oracle is much more valuable than HCA. Again, very big deal. Campus construction has yet to begin, and the official headquarters designation likely won't leave its current residence of Austin, Texas, until the Nashville site is operational, something that might not happen until the end of the decade. Oracle moved its headquarters from Silicon Valley to Austin in 2020. Oracle recently spent $28 billion to buy Cerner Corp, an electric health records company, selecting the world-renowned architect. They also selected the world-renowned architect of Apple's iconic ring-shaped headquarters. So these guys do not play, right? $28 billion to buy Cerner Corp, who I'm going to talk more about in a minute. They're one of only a few electronic health records companies in the country. Then they went all in on the campus, right, paying $270 some million for the land. Then they went out and hired the architect of Apple's iconic ring-shaped headquarters. These are all big boy moves. The CEO, or the chairman of the board really, Ellison, quips that healthcare was the only big problem Elon left us with after tackling electric vehicles and space exploration. So Larry Ellison's a big picture thinker, right? And as he is analyzing all of the big problems that still need to be solved, he thinks there's only one left, and that's healthcare. I tend to agree with him, especially if we can remove the scam, which is health insurance, from our system. With Oracle being here and Mr. Ellison being who he is, it's setting my expectation that Nashville will become an innovation hub, not just for healthcare, but also those companies who believe they bring something to the table that involves tech or AI, said the CEO of Meharry Medical College. Those are big words, right? An innovation hub, not only for healthcare, but also for tech and AI. It may be that Nashville will become another Silicon Valley because of all the companies and startups attracted to Nashville because Oracle is here. Excuse me. You know, I've recently heard Ross, formerly of the Related Companies, who's one of the bigger New York City developers in the country, say the exact same thing about Palm Beach County, Florida, right? So now we've got multiple areas that are claiming to be another Silicon Valley or the next Silicon Valley. Very interesting. So the next Silicon Valley is in Florida and Tennessee. You could also make some arguments that Texas should be considered. I think these are very, very big statements to make. And even if they're only half right, if they only prove themselves to be half right, that is a significant thing for Nashville. Ellison said, "It's the center of our future. It's the center of the industry where we're most concerned about, which is the healthcare industry. We want to be part of the community where our people want to live." Noting that his son David has had a home in the area for many years and visits often. Nashville is a fabulous place to live. It's a great place to raise a family. It has a unique and vibrant culture. As we surveyed our employees in large numbers, Nashville ticked all the boxes. This is where I love to raise a family. This is where I love to go to work. That's why companies are choosing Nashville, because people want to live in Nashville. If your business is really built on recruiting high-value employees, it makes life a heck of a lot easier if you're located in a place they actually want to raise their family. Oracle has leased 120,000 square feet of downtown office space and has roughly 700 local employees today. They've also spent $277 million buying 70 acres of land on the East Bank, which I previously mentioned. Oracle's share price is up 70% this year. If we continue on our current trajectory, reaching a valuation of $1 trillion is inevitable. Are you finally getting how big of a deal Oracle is for Nashville? When Ellison paid $28 billion to acquire Cerner in 2022, he was snagging one of two major electronic health record systems. Oracle is saying, we're rewriting Cerner from the bottom up and we'll make it open. That means companies like myself can tap into the data and build new products outside of Oracle. It's never been like that in the healthcare business before. And it's happening in Nashville. So they went out and paid $28 billion for one of the largest electronic health record systems They're rewriting it from the bottom up to make it open so outside parties outside of Oracle can use the data to move the healthcare industry forward. That is a great idea, a refreshing idea, a big idea. Oracle's AI would listen in the background during patient consultations. The technology would take notes for the patient's file, compile relevant clinical trials and medical journal articles, draft prescriptions for the doctor to approve, and perform other functions that they hope will reduce physician burnout and improve the quality of care. This technology will really change how medicine is practiced. Can you imagine? The healthcare industry behemoth has not changed nearly enough. It is not evolving. It is not getting better. If anything is getting worse, certainly health insurance, which is very, very related to healthcare, has gotten worse. As a matter of fact, my family, we just retired from the health insurance scam this year. We are actually trying a med share plan whereby it's offered through a religious organization whereby every participant in the med share plan contributes a certain amount of money every month. And if you 1 month have medical expenses, the group directs those contributions to you to cover your medical bills as they are approved. So you are really kind of bundling money with a like-minded group of people that are going to help each other out in those months where they have higher than normal medical expenses. So you're kind of insuring one another and eliminating the health insurance scam completely, which if you haven't listened to the recent podcast by Tucker Carlson on the health insurance scam, I would really encourage you to do so. It is as dirty as you can imagine. They are inflating prices. They are hiding profits. They are denying worthwhile procedures because they aren't profitable. They are pushing medicine on you, prescription medicine on you because it is profitable. It is all about making as much money as possible. It has nothing to do with improving healthcare outcomes. If you don't believe me, hear it from people much smarter than I am. Listen to the most recent episode of Tucker Carlson on the topic of health insurance. I think it is eye-opening. It is far past the time that we provide folks with much better options than what our current health insurance providers are offering. So Oracle, we start the show with a number of minutes on Oracle. It's that big of a deal. We'll pick up the pace now. Nordstrom is going private. Oh, you know what? I want to leave you one other thought on Oracle. Larry Ellison is 80 years old. Have you ever seen Larry Ellison? He is the most attractive 80-year-old man I've ever seen. He looks like he's 60. That man is actually 80. He looks good. He's full of energy. Obviously, his brain is firing rapidly on all cylinders. Larry Ellison, very, very impressive dude. If you don't know a lot about Oracle, it's a great story. Larry Ellison is a great story. Spend some time learning that when time permits. Okay, now we're going to move on. Nordstrom is going private. My notes are tiny on this one, so hang in there with me. After a failed attempt, Nordstrom's founding family has struck a $6.25 billion deal to take the troubled department store chain private, partnering with a Mexican retailer to acquire the company. Following the close of the deal, the Nordstrom family will have a majority ownership stake in the company. It's the family's second attempt to take the company private since 2017. Now, we all know department stores, retailers are really struggling. The department store sector has been hit especially hard in recent years, with malls seeing dips in traffic and competition from e-commerce, discounters, and off-price retailers. Sears and JCPenney filed for Chapter 11 protection. Lord & Taylor was liquidated, and Macy's has been maneuvering to bolster its lagging sales, closing underperforming stores as part of the process. Kohl's just replaced its CEO, and Nordstrom has been caught up in those department store doldrums. The foundational principle of Nordstrom is helping customers feel good and look their best. I like that. In the fall, the Nordstrom brothers offered $24.25 in cash per share. The deal represents a premium of roughly 42% of the company's unaffected closing common stock. So the Nordstrom family was so eager to take back their family company so they can rework it and make it viable in the long term, that they paid 42% more than it was worth to do it. You've got to be very, very ambitious to overpay by 42% to get into the big box retail sector right now. Or you've got to be very, very rich. I think they're both. Nordstrom's store fleet has 350 locations. Quote, while a change in ownership does not automatically remedy all the problems with the department store operation, it will allow the family and their backers to take a long-term view of the business and make necessary investments and changes away from the short-term scrutiny of the public markets. Nordstrom is back up, y'all. Keep a look out for Nordstrom. They are going to turn that business around. The public markets are a great mechanism to sell equity in a company for a premium, right? That's what people take their companies public for, is the money received at the exit. It's not necessarily the best way to manage a business long term because you are scrutinized every quarter. People want to see improvement every quarter. And to see improvement every quarter, you've got to use lots of different financial maneuvering. You've got this very short-term perspective. A lot of these companies that are struggling as public market companies do benefit from going private again. X, formerly known as Twitter, another good example. All right, let's keep moving. Another retailer that's struggling, Big Lots. Big Lots closes. Big Lots plans to close all its nearly 900 remaining stores. Unsecured creditors are owed millions of dollars in back rent. They voiced concern about how and if they would be reimbursed. The chain has already shuttered hundreds of stores. At this point, Big Lots will start going out of business sales at the 870 remaining stores. Before it filed for bankruptcy, Big Lots had about 1,400 locations. So they went from 1,400 locations down to 870. And now those 870 are going to be closing. They found a buyer, y'all. So we haven't had a podcast in a while, so this is updating rapidly. I'm going to talk to you about who the buyer is after we get through this initial story. This year has been chock full of store closings, Chapter 11 filings, and liquidations by retailers that have been reeling from the aftershocks of the COVID-19 scamdemic, high interest rates, and consumers tightening their purse strings. A number of chains closed up shop and liquidated this year, including 99-cents only stores, Conn's, Home Plus, Badcock's Home Furniture and more, Bob's Stores, Sam Ash Music, and of course, American Freight. Party City is the next to go, and we're going to touch upon the Party City deal. And the Container Store Group is facing financial uncertainty, which we've talked about at length in previous episodes. Big Lots business model, a lot of people don't understand this, so I want to explain to you what Big Lots does. Big Lots business model was to buy home goods and other merchandise through closeouts, liquidations, and overstocks to sell at relatively low prices to consumers. So they were buying up all of this unwanted merchandise at pennies on the dollar and then trying to resell it to you at what they thought were still low prices. That's the Big Lots business model. I was never a Big Lots guy. I'm not really a bargain shopper like that. I know exactly what I want. I'm just trying to go out and get exactly what I want. I'm not just going to stores to see what kind of junk they've rotated in there. Now, let's keep it moving. Big Lots finds a buyer. A few weeks later, Big Lots has found a buyer. Big Lots has struck a last-minute deal that will save the retailer from liquidation. It agreed to a sale transaction with Gordon Brothers Retail Partners that allows the transfer of Big Lots assets, including stores, distribution centers, and intellectual property, to other retailers and companies. So Gordon Brothers is doing the deal, and then they're going to carve up those assets and sell it to other third parties. That group includes Variety Wholesalers, which owns more than 400 stores in the Southeast and the Mid-Atlantic under the Roses Express, Maxway, Bill's Dollar Stores, Super 10, Super Dollar, and Bargain Town names. Variety Wholesalers intends to acquire between 200 and 400 Big Lots stores, operating them under the Big Lots brand, and up to 2 distribution centers. So they found a creative solution to the Big Lots problem, whereby they're selling all the assets to Gordon Brothers Retail Partners, who's then going to sell a portion of those assets to different groups, including Variety Wholesalers. So we don't need to get into the mechanism that they're using to do that. But nevertheless, Big Lots has found a buyer. That buyer has found some partners that are going to take on some of these Big Lots stores. So we aren't going to have nearly as many vacancies hitting the market for those junior boxes, as we call them, as we initially thought. Party City, another interesting story, which we're going to cover here shortly. They're handling the closing of that business differently than Big Lots is, and we'll kind of compare and contrast them. Let's keep moving. A head-scratching loss for Phillips Plaza. I will tell you, I don't think we have all the details on this. If you've been reading the newspapers in Nashville, they've been making a very big deal about this transaction and the loss that the seller is taking. Just hold out for more information. I don't think we're working with all the pertinent information here. I think there are things we don't know. I think this is a creative exit, and we don't know all the details. So let's talk about it, and then we'll update you in future episodes. Phillips Plaza is under contract to be sold. And it's under contract to be sold for $17 million, which sounds like a lot. Until you realize that the same property last sold in 2019 for $111 million and included a $72 million loan from Truist Bank as part of that transaction. The building's owner is an East Coast investment firm known as Wheelock Street Capital, right? So the stories are saying a property that sold 5 years ago for $111 million just traded for $17 million. Oh my God, how can that be possible in Nashville? I argue that it's not possible, but we'll see as all the details come out. This transaction has not closed. It's simply under contract to be sold, which means very few people know all the details of the transaction at this point. Office tower valuations have been dropping across the country, driven by elevated interest rates and downsizing tenants. Phillips Plaza, formerly known Bank of America Plaza, and located at 414 Union Street, contains 435,000 square feet of space and was built about 40 years ago. The building is anchored by health tech company Philips. A few other tenants include co-working concept Industrials and defense law firm Sherwin Boutique Litigation. The building was 75% leased when Wheelock purchased the building. I've heard it was 95% leased as well. I'm not exactly sure which number is correct. Before it traded at $111 million, it sold before that at $74 million in 2016. So $74 million, then $111 million, and then $17 million. And you're trying to tell me there isn't some other kind of creative structure involved here whereby some of this debt is being assumed or there's something else going on here. You don't go from 111 million to 17 million, even if you've lost some occupancy for a 40-year-old tower in Nashville. Occupancy has plunged to 50% in Phillips Plaza, which isn't great. Not a great situation to be in, but not the end of the world either. Last year, Nashville saw its lowest number of commercial real estate closings in over a decade, but activity has begun to pick up this year. So last year was a very difficult time to be a commercial real estate broker, to be a seller of commercial real estate. Anytime the banks stop lending, it is a difficult business to be in, and I can vouch for that. That's the business that I'm in. We really need banks to loosen up, make it easier to borrow money, even if it's at inflated interest rates. One of the things I tell people is it's not only an interest rate problem. It is an availability of loans problem. There are buyers out there that would pay the higher interest rates if they could get the loans. The problem is the banks have really pulled back on making new loans unless you're the perfect borrower. And until we get easier access to lending, the commercial real estate business is going to continue to just kind of crawl along. I'm hoping we're going to see a big change in that regard in 2025. Now, on the flip side of that, Broadway is popping. Jimmy Buffett's Margaritaville sells in a record-breaking deal. So this is the building that houses Jimmy Buffett's Margaritaville on Broadway. Not the business, just the building. The building home to Jimmy Buffett's Margaritaville sold for an eye-popping $75 million, a record-setting deal for a Broadway building. The transaction was accompanied by a $43 million loan from J.P. Morgan Chase. The seller was a local real estate investor who paid $145,000 for the property in 1991. Can we all bow down to this gentleman? $145,000 to $75 million. Wow. Margaritaville opened in 2010 in the 3-story building at 322 Broadway. The property spans 0.2 acres and the building contains 26,000 square feet. With a per square foot price around $2,870 per square foot, the transaction seemingly breaks a per square foot record for a Broadway building. The Ernest Tubb Record Shop at 417 Broadway sold for about $2,000 per square foot in 2022. 400 Broadway, home to Dierks Bentley's Whiskey Row, sold for about $2,400 a square foot in 2022. Last week, the Lower Broadway building housing Lucky Bastard Saloon was listed for sale for $58 million. If sold at that price, the potential deal would beat out any recent Broadway building deals for a per square foot price, including this one. What recently came out just today about this transaction is that the owner of the building is none other than Todd Graves, the owner of Raising Cane's, who recently paid one of the highest prices ever paid for a condo in Nashville. My man is very wealthy. He's got a business that is growing rapidly, and now he is splashing money around Nashville, setting records for prices paid for Broadway real estate. We've got a few more stories for you here. We're going to talk about Nashville as a top retail market. We're going to talk about how many people are still moving to Tennessee, and I'm quickly going to give you the Party City story. So hang in. Nashville is a top retail market in the country. Thanks to robust demand, low availability, and other factors, Nashville, Tennessee ranks as one of the top retail markets in the country. It actually ranks as number 7 with a vacancy rate of only 3%, which is the second lowest in the country. Asking rent growth, right? So the rent is going up about 3% every year. That brings us in at number 7. Ahead of us on the list, number 1, Phoenix, number 2, Orlando, number 3, Las Vegas, number 4, Atlanta, number 5, Columbus, and number 6, Charlotte. Nashville coming in again at number 7. Commonly shared conditions across the top markets within the analysis include strong population and employment growth, more business-friendly tax and regulation policies, and warm weather. Yo, that is a real simple way to put it, right? All of these top 10 have population growth, friendly tax environment, and warm weather. It's that simple. Nashville's primary economic driver is its explosive population growth. The metropolitan statistical area has seen growth of over 27% since 2010. A significant factor behind the tight market conditions in Nashville has been slowing development. Again, remember, I just talked about how difficult it was to borrow money the last few years. The most difficult area to borrow money is ground up development. Ground up development has really screeched to a halt after the last few years. With 730,000 square feet under construction, the pipeline is 35% below its 10-year average. We are not building fast enough in Nashville. I'm really hoping that rights itself in 2025. Demand for retail properties in Nashville remains high, and with construction declining, the market is likely to remain tight for the foreseeable future. While there are some potential headwinds, including consumer financial health, higher borrowing costs, and a cooling labor market, the Nashville retail market is expected to remain balanced, given the market's minimal space availability, and continued lack of new development. So, Nashville is going to be in this top 10 list for a long time until we can really get ahead with bringing more square footage online. Again, that is going to be determined by how the banks loosen up and start lending money again. Now, talking about population growth, Tennessee remains one of the top states in the country when it comes to attracting new residents. The state ranks number 5 on the U-Haul International's latest growth index for the second year in a row. The 5th consecutive year the volunteer state has been in the top 10. A lot of people are moving here because of how pro-business our government is. Tennessee is a great place to start a business with a low tax burden. South Carolina jumped 3 spots this year, kicking Texas out of the number 2 spot. North Carolina and Florida round out the top 5 at number 3 and number 4, respectively. So we're right where we need to be at number 5 on the list. You know, population growth is good for everyone. The more people you have really truly wanting to live in a place, of course, that's going to bid prices up, right? That's going to bid prices up for houses, for land, for businesses. Things are going to get more expensive, but it's also easier to make money. You know, if you're a business person, if you're a real estate investor, the thing that you're really looking for in a market to invest in is it growing? Anytime a market is growing, it's easier to make money there. So while prices are going to go up because demand is going up, it's easier to make money in those marketplaces. So population growth is good. It's good for everyone. There's more money in circulation. There's more money for you to get your hands on. Go to a place whose best years are behind it and they are on a downward trend and see how hard it is to make money there. I spent 10 years in a place like that called Milwaukee, Wisconsin. And while I did fine, the average person really struggled to get by there. There's less money in circulation. There's less money for you to go out and get for yourself. So don't ever convince yourself that Nashville growing is a bad thing. Prices are going to go up, but there's more money in circulation for you to go out and get. There are more options for you to earn. It is much, much better to live in a place that's growing than it is to live in a place that's on a downward trend whose best years are behind it. Now last, Party City. This is a big story, but we're going to keep it simple. Party City closes abruptly. Nearly 700 Party City store leases are now slated for auction, which is an interesting idea, right? So Party City closes doors, said we're done. Liquidate everything we've got, close the doors. And then to raise capital, for Party City, they say, hey, maybe our leases have value. Maybe people will pay us to take over our leases, right? So you pay X amount to get into a lease, and then as you're the tenant, now you've still got to pay the landlord, you've got to pay all those expenses. So, a lease isn't necessarily seen as an asset that's got value very often, but Party City seems to think their leases do. And Party City's been through bankruptcy before, which probably means they renegotiated a lot of their leases. A lot of their leases are now probably below market and in fairly good locations. They're saying, hey, we'll sell you our below market leases if you pay us for them, which doesn't happen that often. After filing for Chapter 11 bankruptcy protection last month, Party City is winding down its operations and holding going out of business sales at its store fleet across the nation. This is a nearly 40-year-old retail chain. Now it's got 695 Party City leases in 44 states, so all over the country. The auction is part of the aftermath of last year's stream of retailer Chapter 11 filings, chain liquidations, and store closing as the industry was pummeled by high interest rates, increasing their costs, consumers tightening their purse strings amid high inflation, and the aftershocks of the scamdemic. Party City specifically cited an immensely challenging environment driven by inflationary pressures on costs and consumer spending. The available leases are for freestanding stores as well as those located in power centers, strips, and city street locations. The Party City stores range wildly from 7,000 all the way up to 46,000 square feet. I'd never heard of a 46,000 square foot Party City before. That surprised me. You've got a number of strong candidates for this real estate. The list includes gyms and entertainment tenants, dollar stores, local specialty retailers, furniture stores, and medical office clinics. The stores are ready for immediate occupancy with favorable lease terms in both suburban and urban retail markets. So, Party City has taken a different approach to closing their business compared to Big Lots, right? Big Lots was trying to keep the name alive, trying to keep the employees employed, supposedly, trying to keep a buyer of their assets in their lease space, whereby Party City says, hey, we don't have anything of value here. No one wants our assets. All we have is below market leases that we're going to try to auction across the country. So two very different approaches, both companies citing the same reasons for their failure. It was a rough year. 2024 was a rough year for retail. What's interesting about it is it didn't really unlock very much retail real estate for some of these retailers that have stronger balance sheets, stronger businesses to come in and backfill, right? We're at 3% vacancy for retail in Nashville, and none of these problems that these retailers experienced in 2024 has really unlocked much available real estate in Nashville. We're only at 3%, and we've got a weak pipeline. So retail is going to continue to be hard to get your hands on. As those leases turn over, those lease rates are going to go up for the same reason. So it is a very, very good time to be the owner of retail real estate in and around Nashville. And I hope this is recognized by the big boy developers in town and they start building more. It's time to get back to work bringing buildings out of the ground in Nashville. I know the prices are high. I know construction costs are high. I know it's a difficult business to be in. It is what it is. There is demand in the marketplace that needs to be met by the area developers. I hope 2025 is the year that we all get back to work making that happen. Now, that rounds out today's show. We brought you the top 10 stories of the week, and actually because we've been off, it's top 10 stories from the past few weeks. I hope we've brought you a little value in today's show. I'm excited to get back into the routine. As always, this episode was brought to you by Beechwood Commercial Real Estate Services. We are specialists in listing and selling commercial real estate in Nashville and the Southeast. If you own a commercial property that you're considering selling and you'd like us to walk you through exactly what that would look like to bring your specific property to the marketplace today, I encourage you to reach out and we will do our best to guide you through that process. Thanks so much, and we'll talk to you next week.